Alright, so in this lesson we're going to go ahead and cover leverage and margin. And as you can see, I've included a little quote here, which reads as follows. When you combine ignorance and leverage, you get some pretty interesting results. And of course, the great Warren Buffett said that. So hopefully this lesson might provide some context behind that quote. Intraday currency fluctuations are typically very small, moving less than 1%, making the currency markets one of the least volatile markets. Therefore, traders rely on leverage to increase potential gains on relatively small price movements. A broker can offer leverage as high as 250 to 1, although most brokers meant for retail traders offer leverage at levels typically below 100 to 1. Leverage allows you to trade much larger positions while using very little of your own capital. While leverage seems like a huge benefit in terms of allowing you to generate sizable gains with a very small investment, leverage can also be an extreme negative if a trade moves against you in the absence of proper risk management practices, because your losses will be magnified. You shouldn't be afraid of leverage as long as proper risk management is in place, which will help you better control potential drawdowns. So moving on to the next slide, to calculate the amount of leverage you are using, simply divide the total value of your open positions by the amount of capital in your account, also known as account equity. So as you can see here, I've included this formula. So leverage equals total notional value of trades divided by account equity. So total notional value is simply just, if you buy, 10,000 units of euro dollar, and let's say the euro dollar pair is, trading at 1.1, hypothetically, you'll get your notional value by multiplying those 10,000 units by 1.1. So that's the total notional value of a trade, and then account equity is just the amount of capital in your current account. And yeah, so just as another example, so if you were to open an account with $1,000 of capital, aka equity, and buy one mini lot of USD Canadian dollar, so that would be a $10,000 trade size, your account leverage ratio is 10 to 1. So here's I kind of listed out. So you have your account with $1,000 of capital, equity. Both those words are interchangeable. Here is our one mini lot purchased of the US dollar, Canadian dollar, which has a $10,000 trade size. Remember, US dollar is the base currency. So if we're buying 10,000 units, that will be a $10,000 trade size. And therefore, simply to find the leverage ratio, that's just 10,000 divided by 1,000, which gives you 10 to 1. And furthermore, if you were to open two mini lots of US dollar, Canadian dollar for a $20,000 trade size, therefore your leverage ratio would be 20 to 1, given that you still have the same $1,000 equity in your account. And so one thing I've included, if you ever want to check your calculations, just using kind of a tool, there are numerous leverage and margin calculators out there. You just have to go onto Google, and one will easily pop up. I'm just using this one, oanda.com. They have a pretty simple and easy to use calculator. Margin is a similar concept and is easy to understand. Margin is the capital required to open or maintain a position. Let's say you would like to buy or sell a position with a notional value of $100,000. Now, your broker requires a 1% margin requirement to open and maintain the position. Therefore, you will need $1,000 of margin to meet that 1% required by your broker. So this is essentially 100 to 1 leverage. Because your broker requires this 1% margin, if you fall below margin requirements, let's say your trade moves against you, your broker may issue a margin call requiring you to deposit additional margin to meet the 1% margin requirement. And of course, depending on brokers, margin requirements certainly vary, and could be greater or lesser than this 1% that we have in the example here. So let's go ahead and look at the potential effects of using leverage. So the use of leverage can have extreme negative effects if not used properly. So here's an example of a trader using appropriate leverage versus a trader using excessive leverage. So we have trader A and trader B. So trader A, both traders have $1,000 of account equity, but the difference is trader A has a trade with a much greater notional value than trader B. So trader A has a $100,000 notional trade, while trader B is only $10,000. So therefore trader A's leverage ratio is 100 to 1, while trader B's leverage ratio is 10 to 1. So as you can see here, a 100 pip loss for trader A will be 10 times greater than the loss experienced by trader B for a 100 pip loss. So just something to be aware of. Obviously, the greater leverage you use, the more potential there is for downside risk. Alright, so that's a review of leverage and margin. So I hope you have a solid understanding of both concepts.